Well, hello everyone, welcome back. I thought what we do today is just simply define what a mutual fund is and tell you a little bit about how they operate and what they do and so forth. But mostly the point of today's video is just to give you a basic introduction to mutual funds and what they are. So a mutual fund is really it's an investment, it's a security that you can purchase or invest in. But the fund, if you will, let's just kind of visualize the fund as just a big circle here. And the fund has thousands of investors. You could be one, but then you're going to invest along with thousands and thousands of other people, okay, into this big pot of money. And then the fund has a manager. Okay, and the manager's job is then to decide what to do with those funds. It has all these dollars, but depending on the type of fund you've invested in most cases you've invested it with the expectation that you're going to get some sort of return for it. So let's just take a quick side trip over here. There are different kinds of mutual funds. I'll highlight some of the most common ones. One is called an equity fund. One is called a fixed income fund. And then you've probably all heard of money market funds. And equity funds, by and large, then invest in equities, in other words, stocks. Fixed income funds invest in other securities that typically pay interest. So those might be bond funds, for example. And then money market funds just invest in very, very short maturity kinds of instruments that pay a pretty low interest rate, but it's pretty liquid and pretty typically pretty secure and pretty safe. So there are separate videos on each of these that go into much greater detail, but just so that they're up here for you for this video, I wanted to make sure that they were here. So let's suppose that this is an equity fund, just to make it easy. And you decided that you wanted to invest some dollars. Let's just say this is you over here. And you decided you wanted to invest some dollars into this fund. So you open an account with the fund, or maybe you have an account with a brokerage of some sort. Maybe you have an account with Fidelity or with Charles Schwab or something like that. And then you can direct your investment into this fund. So let's say you invest $1,000 into this fund. So what you then own is $1,000 worth of equity fund shares, right? Let's just call this ABC Equity Fund. So then you own 1,000. Sorry, I keep making this up here, but let's say that each share is $1. So just to make the math easy, you now own 1,000 shares of ABC Equity Fund. Okay. Well, if ABC Equity Fund's manager only takes this money that comes in here and invests in well, let's just make it even easier and just say that he doesn't do anything with it and he just leaves it in cash. Then your return is going to be pretty low. And if your fund was advertised as being an equity fund, then you have some expectation that the manager is actually going to follow the investment policy of that fund and invest the money that's in that fund at least substantially in equities. And so what does that mean? Well, that means that the manager then is the one who's responsible for being the expert. In some ways, it takes the investor out of the job of being an expert investor, and instead he just picks a type of fund that seems to fit the investment objective at that time. So, the investor has decided, this is you've decided that at this moment in your life, you have $1,000 that you want to invest into an equity fund because you want a higher rate of return than other forms of investments. And typically equity funds can provide that. And so, but then it's the manager's job then to go out and say, well, how do I want to invest the money that people are putting into my fund? And he then surveys the market. And he keeps track of the market and what's going on, and will have some ideas. And so he may come back and decide that, Coca-Cola, the symbol is KO, but Coca-Cola is a good investment. Maybe Walmart is a good investment. Maybe he likes Target. Maybe he likes Ford, and maybe he likes Microsoft. Okay, and so then the manager goes out to the marketplace and actually buys shares of Coke and shares of Walmart and shares of Target and Ford and Microsoft. And those companies, that's the stock of those companies. He buys the stock or equity. Okay, stock is equity, thus equity fund, right? So he buys the stock of these companies, and then the fund owns those shares of stock. So you as the investor own shares in the fund. The fund in turn owns shares of the stock. And so then if the stock pays, for example, a dividend, then the fund can, that's new cash into the fund, and the fund can elect then to pay dividends out to its shareholders, to its fund holders. Of course, then when the shares of these stocks go up or down, so if Microsoft goes up and Ford goes down and Target goes down, but Walmart goes up and Coke goes up, the changes in all those market values change the total value of this fund. And every single day, remember back when you bought into this fund, it was $1 a share. That's called the net asset value. Okay. Or it's really the share price. But every single day, that dollar changes. Now, it doesn't fluctuate during the day. It only is recalculated at the end of the day, at the end of each trading day. And so then, if it was a good, let's just say it was a good day, and at the end of that good day, oops, sorry about that. At the end of that good day, this dollar went to $1.10. Okay. Well, then your 1,000 shares went up 10%. So your $1,000 investment is now worth $1,100 on paper, okay, because the share price went up to $1.10. Same thing holds if it went down to 90 cents. Your 1,000 shares would only be worth 90 cents instead of $1, and so your investment would only be worth $900. And of course, when I say it's on paper, those are just that's the value at the end of each day. You don't actually lose that money until you actually sell the shares. You have to actually sell the shares and cash them in before you actually lose the money. Okay, so this is really as if you own the stock itself. And when the stock goes up and down in value, you don't actually lose that money, but you realize it when you sell it. But what you're really doing in a mutual fund is hiring an expert manager to do really the hard work in investing, and that hard work in investing is figuring out, is Coke, Walmart, Target, Ford, and Microsoft, are those good stocks? And he'll have an expert research team and obviously hopefully some experience, and be able to make very good decisions for the fund. Now most funds, I'm only showing you 5 stocks here. Most funds own several stocks. In fact, most own usually about a minimum of 25, but they can own up to 100 or more different stocks in their portfolio. Okay, well, I think that gives you a pretty good general introduction to what a mutual fund is. Again, there will be other videos that go into a little bit more detail about equity funds and fixed income funds and money market funds. And we will also talk in other videos about, squeeze this in down here, about mutual fund expenses, which are very important, and mutual fund performance, so that you can understand a little bit more in detail about how to compare one fund to the other. Okay, that's it for this video. We'll see you next time.